What a year, obviously, that we just closed out. Major averages also posting their 5th positive year in 6. But the last month, obviously, not as great as someone had expected. That Santa Claus rally, Jim, did not show up. So as we are looking at the month of January, there was an article on CNBC Pro this morning talking about sort of these 3 potential landmines, or maybe they're positive catalysts. You've got the jobs report, you've got a Fed meeting, and of course, you've got the earnings getting started. So as we're looking sort of broad market, big picture, let's start there on January 2nd. Jim, what do you thinking?
Well, the things that you listed, I think we feel fairly comfortable that they're in a good position. Namely, the economy here in the U.S. is strong. Profit picture looks good. I mean, we can debate it, but it really hasn't gone down over the last couple of months in terms of estimates for this coming year. Where I think there is uncertainty, and I'm actually happy with some uncertainty, is what presidential policies will come out after January 20th and what their impact will be. And I say that's healthy because a little bit of uncertainty, which probably is the manifestation or the reason for the manifestation of some down markets in the last couple of weeks of December, actually resets the bar that we can go higher from here. Now, let me be clear. I don't think that uncertainty is over. I do see a good year ahead on the back of the economy and the profit picture that I mentioned. But I think you could see a little bit lower before you go higher. And again, that uncertainty and a little bit of a resetting of prices is good in the long run. You just have to kind of buckle your seatbelt and get through whatever volatility the first quarter may bring.
Liz, got some mixed messages today from some of the banks. B of A says, look, we're one step closer to euphoria. Sentiment can stay elevated. We can be in this bull market for a little bit longer, but then HSBC says, well, don't buy the dip just yet. The next few weeks will remain choppy. Where are we? Where are we going?
So, I mean, first of all, we have to take stock of where we've been, right? We just finished out a positive 23% year after a positive 24% year.
Incredible.
Typically, when the market is up over 50% in 2 years, you still see positivity in the following 12 months, but not to the magnitude that we've seen. So manage your expectations about what might happen in 2025. So then the big question here, after a rough finish to 2024, is this tradable, is this buyable, or is this the beginning of something deeper in the downtrend? And I think that some of this is tradable and buyable, but I would expect that between now and, let's say, inauguration or the end of January, we do see more bumps. We've got earnings season that'll start. We have, as Jim mentioned, a lot of policy uncertainty that's still here, but I think this is a healthier place to be. We're only up about 1.7% now since the election, which is less extended than we were. The original rally was up 5.3%.
Sure.
We went really fast, really quickly. So I think this is a healthier place to be, and you can buy some of these dips, but I would expect there to be more bumps along the way, especially with yields at these levels.
Joe, of course, they brought up inauguration. How could I forget that from a possible catalyst or a landmine? I mean, how can you sort of play that card when we just don't know what policy will be, even though the president-elect has laid out some things he wants to do on the very first day of office that could impact the markets?
Well, first of all, as it relates to the incoming administration, I just think there's a lack of clarity on what the reality of their policies ultimately are going to be. So I don't think you waste your time trying to figure out how do I allocate my portfolio according to what fiscal policy will be implemented or not implemented. I think the biggest potential landmine that's in front of us here in the next 30 days is earnings, the potential for there to be disappointment surrounding earnings growth. And I think you treat the first several weeks of January looking at the market and understanding that the market is trying to develop its personality. If you go back prior years, that's what the early weeks of January are all about. What's the personality of the market going to be for the year? Where can the market find leadership? And I think if you study the composition of what we have today, first of all, it's surprising to me that we're actually higher. Let's remember we came into 2025 kind of skidding on our heels a little bit, and with a lot of sentiment reversing itself, expecting that there would be some trepidation and corrective behavior early in the month. You also today have a lot of mean reversion within the market. So the Russell is the best performer of the 3 major indexes. You've got energy, which is strong. You have some material names, which are strong. You have the gold stocks that are strong. And then you have some of the momentum names like AppLovin, like Coinbase, like Vertiv, which ended the year in a downslope, those are recovering. So mean reversion really is a story early on, and I think the first couple of weeks you have to be judicious. You just kind of have to study, okay, what is the leadership form going to take?
Do you think that what you're seeing in materials particularly is that more of that mean reversion than anything else? Because obviously a big laggard for the year, but not sustainable?
I think everything about today is really mean reversion more than anything else, and I think you have to allow time to pass before you could have the confidence to say to yourself, okay, we've got an evolving trend.
As Joe was talking, Josh, I was thinking of the word trepidation, which is what you said. Yeah. But Josh, UBS thinks that many investor concerns are overblown. They're looking at history, saying you don't need to worry so much.
Okay, I think that's probably when you want to start worrying.
Okay.
The majority of Wall Street was way underweight equities going into 2024. They told us we were going to have to pay for the complacency of 2023. The yield curve inverted, and the SOM rule was triggered, and blah, blah, blah. I tend not to pay people that are watching it. I'm on this show for like 13 years now. People already know what I'm going to say before I say it, but I'm going to say it anyway. Courtney, this is not how you invest, okay? If you want to listen to people's tactical ideas about the first quarter, the first month of the year, you're welcome to do that, and maybe you act on it, maybe you don't. Maybe it's just good food for thought. Maybe it tempers your expectations. I'm fine with all of that stuff. I think what you really need to focus on here is flows. Very simply put, January should be a great month for flows. Look at the amount of money that poured into ETFs last year. Even though we didn't get a great December in terms of upside for stocks, we had tons of money coming into the ETF market. It's now $10 trillion. Look at 401ks, record balances. That's not going to change. The flows will continue to come in. The shocks will come along. We don't know what will cause them. Maybe it's Trump related. Maybe it isn't. Maybe it's trade related. Maybe something else. Bigger picture, people are investing. Margins are growing in corporate America from 2001 to 2023. You had the average profit margin growth something like 2%, and then last year it was 8%. And now you've got this AI kicker. You've got the Fortune 500 companies that are implementing these tools into their workflows. You think margins all of a sudden are going to mean revert negative? I don't think so. You're going to get continued earnings surprises, and you've got these gigantic, incredible, best companies we've ever had in this country, all still investable, even though some of the valuations they were elevated, some of them are not. So I think the setup is good, and I think you want to tune out a lot of the noise. Don't worry about, oh, today is it rebalancing, tomorrow is it something else. Just focus on what you personally want to accomplish as an investor and what you need to do early in the year to get that process started. I'm not saying this is going to occur, but how do you treat the month of January if the flows were to disappoint? If we have less flows, who would? I guess here's the question: who would they disappoint? Who would they disappoint? Well, you're making the observation that generally in the month of January you get strong flows, and that should give you confidence about the remainder of the year. If you're observing the flows and you say to yourself, you know what, the flows so far in this month are somewhat disappointing. I'm not saying that's what's going to occur, but let's play the other side of that. If the flows disappoint and you don't see that type of confidence, is there a message there that you extrapolate for the remainder of the year? No, I think it's a great outcome. I don't see why the 73 million millennials who are 30 years plus from retirement want to buy stocks from their parents at all-time record highs. So if flows should disappoint in January, if we don't get the quote-unquote January effect, if the year doesn't get off to a great start, that's probably an even better outcome for most of the people who are investing currently. They're buying lower prices. Look, this is a message that I refuse to back off from. If you're an investor who is a forced saver and forced buyer in a 401k or otherwise, if you've got money at my firm, at Liz's firm SoFi, if you've got money with Jimmy Lebenthal, with one of the funds at Joe's firm, you don't want to buy all-time highs if you don't have to. If you're 85, you're not going to like what I'm saying. If you're any age under that, you should be happy to hear what I'm telling you. You want the pullback, especially early in the year. That kind of front-end loaded buying opportunity always works out great.